Hello, hello, hello. Good evening, everybody. Had a couple of delays with the link on Zoom, but we're situated. Did anyone have a hard time getting in tonight? Let me know. Let me know. Let's see. You know, Sandy said. Thank you, Sandy. Hi, Perry. Hi, Sandy. Hi, everybody. Good to see you all. You should be seeing my screen. Oh, I'm so excited for more options. Options for 2 months. Uh, Okay, we're gonna give it just one more second, just in case anybody is having a hard time. Interesting market. Market looks like it was trying to bounce today a little bit, huh? Hope trading is going well. All right, I think everyone's in who's getting in, so let me make sure we're up, going, ready to go. Welcome to the Market Watch Group. Options Foundations 2.0. 2.0. The next version, the next iteration of goodness. Key concept. So we did our first session the same, second session the same. So we have literally 14 more sessions, and we're going to take the other 6 to turn it into 14. It's going to be great because we have a lot of time for application. We'll get even into some today. If you missed on Tuesday, we were jumping into the platform a little bit, making sure you're comfortable, and if it's not Thinkorswim that you're on, that you are comfortable asking the right questions. You need, if you're gonna trade options, you need to have a model, an options pricing model. When your people are like, what does that mean? So an option pricing model, the original options pricing model, gold star, if anyone can tell me the original pricing model, it was a Nobel Prize winning formula. Anybody want to give it a? Yeah, Sandy wins. Black Scholes. Myron Scholes and Fisher Black. And a guy by the name of Robert Merton all won Nobel Prizes for their work on options pricing to standardize how we price options in order to then be able to trade them better. Black Scholes gave way to binomial. That was the next model that we tended to see, was the binomial. And now, depending on what platform you're on, is it still okay? Yes. Yes. It's funny that you ask, because on Thinkorswim, they use Bjerkson Stensland. I don't know what their first names are, but Bjerkson and Stensland created a model. And unless that's one person and that's a hyphenated last name, that's even better. But I've actually taken, and I'm like, okay, I want to know the difference. And I played with variables as I switched. You can actually toggle from Black Scholes to binomial to Bjerkson Stensland, and very, very minimal. I mean, it's not that much of a difference. So anyway, yes, still viable, still valid. Today, we're talking about key concepts, terminology, basic option strategies. What do we mean when we say basic option strategies? We're talking about buying options, buying calls, buying puts. Everything we did on our first session was from the perspective of a buyer. Buyers have rights, sellers have obligations. And so, right, we want to make sure that we've laid some groundwork on Tuesday with some definitions and some characteristics and some basic understandings. But today we're going to get into concepts, terminologies, and then we'll really dive into buying calls and puts. Disclaimers, as always, be careful. We're not advisors. We're not brokers. We don't give recommendations or guidance. We just simply provide illustrations and education. Make sure that you know what you're doing when you're getting into a trade. Alerts. I know I keep talking about it, so here's an update. I spoke with the powers that be. Apparently, there's a few hoops regarding privacy policies that we have to jump through. I thought it was going to be pretty quick and easy, but there's just a couple of steps. So that's coming up soon. And then I'll tell you also one more thing that's coming down the pipe. I'm trying to get rid of Zoom. That's my goal. I don't want to have all these different links all the time. And what I'm looking at, and this is going to be another way, Steven's not here tonight, but he would be happy to hear this, would be basically moving everybody to Discord for our meetings and for our interactions. And it'll make it so that you don't have to click links and do this and that. You just pop in, ready to go. All right, let's dive in. Today's agenda. First and foremost, we want to go through some terminology. Make sure you have a good sense of when somebody says premium or strike or in the money or at the money or out of the money or anything along those lines. What do they mean? What does it mean to us? Key concepts, understanding a few things. We're going to scratch the surface. We're just going to really lightly look at the Greeks. We have an entire session planned for the Greeks. Delta, theta, vega, gamma, right? And what does that mean? And how do we integrate that into what we're doing? We're going to talk about basic option strategies, which means buying calls, buying puts, and then a summary. Now, I want you to remember, these are building blocks. We are building blocks. In order for us to think about a spread trade, if you're like, oh, I hear credit spreads are nice, or I hear bull call spread is nice, or whatever, we got to learn to crawl, then we'll walk, then we'll run, and then we'll fly. Because you think I'm joking. I'm not. Butterflies and iron condors. those are the most sophisticated, most legged strategies. 3 legs, 4 legs. So yeah, we'll be flying. Absolutely. Okay. Let's dive in. So basic options terminology. Call option. What are we doing with a call? We went through this a little bit, but again, as I said, options are just not intuitive concepts where you can just be like, oh, if I read this definition, I can wrap my mind around it. No, you got to just memorize it over and over. What is a call? Gives a buyer, the holder, the right, but not the obligation. Buyers have rights, sellers have obligations. I'm going to drill that into your head. Buyers' rights, sellers' obligations. To buy an underlying asset at a specific price, that's the strike. That's part of the contract's characteristics. At or before the expiration date. Again, part of the contract. What are the expiration dates? Let's, we're going to get to that. Never mind. I see it down there. I'm like, let's get to it. A put option. Now, actually, before I go on, this is actually one area where there is a little bit of intuitiveness. When we say call, what do you mean call? You have the right to call somebody out. If I call you out, that means that I'm exercising my option. I said, I want to enforce the terms of this contract. The stock is at 70. I have the right to buy it for 65. I'm going to exercise that. I might have this in the slides. I can't remember. Exercise, we notify our broker. And we say, I want to exercise my option. And the broker notifies the OCC, Options Clearing Corp. And they say, my customer wants to exercise. Now, the OCC, they have a couple of pools. And in this pool over here, they have buyers. And in this pool over here, they have sellers. So all the brokers pool their buyers and sellers into these pools. And so somebody in the buyer's pool raised their hand and said, I want to execute. I want to exercise this option and then force it. So the OCC says, oh, okay. I'm going to randomly, they just reach their hand in the other pool and grab somebody and pull them out. And they say, ding, 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 it's you. You are getting assigned. Exercise is the buyers enforcing the contract. Assignment is the random process that the OCC puts people through to enforce and say, you have to now either A, deliver your stock to the buyer, and they'll give you the money for it. Or give us your money. The buyer of this put has some stock they want to force you to buy. That's what a put is. A put option gives the holder, the buyer, the right, the obligation to sell an underlying asset at a specific price. That's your strike at or before expiration. So if I have a put, I have the right to sell. I'm putting it to you. I'm putting this to you. Call, put, right? I'm going to put them the option. Okay. Now, questions. Strike price. That's the agreed upon price. That's the predetermined price at which the underlying asset can either be bought if it's a call or sold if it's a put. So every contract is going to have a symbol, strike price, and an expiration date. The assumption is that it controls 100 shares. Every contract controls 100 shares. That's the standard. The standard expiration date. So the expiration date is when the option contract expires. After this date, the option is no longer valid. At expiration, a few things might happen. Okay. Now, everyone thinks expiration is the third Friday, 4 p.m. It's not. That's when they stop trading. But theoretically, that option is open until Saturday at midnight. So beyond when you can trade it, people are like, well, if you can't trade it, what's the point? I can exercise it still. Right? I can still exercise it at any point if I want to. Is there a reason to? I mean, I don't know. If news came out, maybe somebody would do it. It doesn't happen often, but it does exist until the third Saturday. Now, what happens at expiration? If the contract is out the money, that means that there's no intrinsic value. That means I have the right to buy a $55 stock and the stock's at 52. There's no value there. Right? That's not of any benefit to me. I'd rather just go buy the stock for 52. What's going to happen? An option that is out of the money at expiration will expire worthless. That's what happens. It expires worthless. If the option is in the money by a penny, 1 penny. So if I have a right to buy a stock at $50 and the stock closes at $50.02, my broker's like, oh, you have an in the money option. And they auto exercise. They're going to automatically, anything that's in the money, even by a penny, they're going to be like, oh, well, we don't want you to lose your penny. They can't sell it anymore because it's closed. What can they do? Exercise. And they say, we're going to buy that $50.01 stock for $50 and put it in your account. And you're going to owe us the money for it. And when you come in on Monday, you're going to see a margin requirement to buy the stock, and the stock's sitting in your account. They did it automatically. Now, what that means, if every single option that is a penny in the money or more is exercised, that means that if your option is in the money and you're a seller, what can you expect? Automatic assignment. If you leave it open and it's open and at expiration, you will be assigned. They're going to take it from you or put it to you. And then you're going to owe for it, right? So we want to make sure we're really clear. And this is like, there is an extreme, it's extreme, but there was an extreme scenario where a 19-year-old kid did way too big of a trade, a spread trade on Amazon. And it was in between the spread, and it looked like he was going to owe $700,000 on a $20,000 account. It's not what was going to happen. It was all going to kind of wash itself out. He was going to lose some money, but not that much. And the kid took his own life. This was in 2020 from Robinhood. Huge deal. Look it up. It was crazy. we got to know what we're doing here, right? I absolutely want to make sure I want you to trade options. I love options, but I want to make sure that you are eyes wide open with everything you do. So if there's any aspect of options that you're like, I'm not quite sure what this, come and ask. Got it? Got it. Premium, that's what you pay. How is a premium quoted per share? So when you see an option quote, the premium will say something like $2. And you're like, $2, but it controls 100 contracts. So you need to multiply that by 100. That's your premium per contract. They don't price it per contract, they price it per share. Then you multiply by 100, and that's the premium. So that's what you either get to buy the contract or what you get paid. If you're selling the contract, it's essentially the cost of the option. Whew, that was a lot right there. I think I actually see somebody dropped out. I'm like, I scared them away. Honestly, I feel good about that. Why? Because if I'm talking about this and you're like, no, I don't want to do this. Great. Then don't trade options for sure. And I just saved you a lot of money for, trying to, I tell people this a lot. Don't dabble. Do not dabble in options. You're either committed or you're not. Commit and you're all in, and let's do this and let's make sure we're good to go. Or you're not, and you're going to say, hey, it's not for me, Scott. I'm going to trade stocks. Got it. No problem. No problem. What else? Time decay, theta. So we're going to give you a little. So time decay, the element of time value is one of the things that makes options so unique. So you buy it, and when you pay for your option, you pay for this. We talked about this a little last week. If you missed last week, you can go back. But there's intrinsic value, if it has any, if it's in the money. If it's not, it's all intrinsic. Excuse me, it's all extrinsic. It's all time. So if there's no intrinsic, it's only extrinsic. If it's intrinsic, it's a combination of intrinsic and extrinsic. But the prevalence of time value is what creates time decay. If I have $2 per contract, that is time value, and I get to expiration, well, if there's no time value. And what happens is everyone thinks, well, I paid this much and I'm going to lose, and then I get to expiration. That's not how it works, actually. The way that time decay works is it actually starts off slowly. We're doing okay. Oh, and then it falls off a cliff. So it's important for us to understand that's how time works, because we don't want to be like, it's okay, I still have time. If I'm halfway through this trade, I can't be like, oh, I still have time. This is where you are halfway through the trade. You've got a few days, and then shit's going to hit the fan, and that's going to drop off, and you're going to lose all that time value very quickly, especially if this trade's still uncertain. If it's deep in the money or deep out of the money, less so. But most of the time, we're going to be around the money. So time value is so important for us to understand and to be able to quantify, right? So think about it like an ice cube. You open the freezer, you pull out an ice cube. That's buying an option. What's it going to do? It's going to start melting, right? And if you just set it down, it would melt at a pretty consistent rate. But that's not what's happening. You're walking towards a heat source expiration. And the closer you get, the hotter it is, the faster it melts. That is time decay. It decreases at an increasing rate. Magical. Open interest. Open interest is the total number of outstanding option contracts in the market, as opposed to volume, which is the number that traded that day. It's tough because volume, you don't know if they bought it or sold it. Could be half buyers, half sellers. No. Sandy asked a great question. She says, does that mean available for sale? There is an unlimited supply available for sale. Why? Because the market makers have entered into a contractual obligation to maintain a liquid market. That's they're obligated. They can't just be like, yeah, I don't want it. You have to. You're a market maker. What do they get for that obligation? They get to buy the bid and sell the ask, right? So they get to make 10 cents, 15 cents, which per contract is $10 or $15 per contract on every contract, right? So there's plenty for them there. But yeah, they have to. So when you're buying an option, you're not buying an option that's existing typically. Usually the market maker is going to create it and sell it to you. Now, somebody out there might have recently done a covered call or something where they had a sell leg. And if they did that sell leg, the option market maker was the buyer. And if the market maker bought something, now they can sell that to you. So sometimes they may be selling to you from their own inventory. Sometimes they're going to be creating. How do you create a contract? You write it. W-R-I-T-E, write. So if you ever hear people say, I'm going to write a covered call, what does that mean? They're creating a contract for a stock that they own. They're the creator. They're writing the contract out. I am willing to sell my stock for X. I mean, it's not actually that formal. They just simply say, I want to sell this option. Well, if they have an options agreement and they have 100 shares, broker's like, great, we'll put that out there for you. So open interest means what's already happened. If I go out and I buy 10, Sandy buys 10, Shelly buys 10, Perry buys 10, all of those are adding to the open interest. But if Fred sells 20, then it's 40 bought, 20 sold, and open interest is going to go up by 20. So it's a running total of what's happened. Why is that important to us? Liquidity. If I have 50 contracts of open interest, that probably means there's one market maker. And he's probably a shady bastard. Not really. He could be a very good person, and she could be a good person too. What it means is they don't have any competition. So when you look at your option quote, they're going to be like, well, you can, if you're a seller, it's $1.50. If you're a buyer, it's $1.80. What does that mean? It means you buy it at $1.80 and immediately you're down 30 cents. You're down. If you've ever heard the term overcome the spread, that's what's happening. It doesn't necessarily have an influence on strike prices. It can. The more open interest, the more strike prices they're going to release to just, right? So if it's $5 increments or $1 increments, things like that, it has an influence primarily on the spread between bid and ask. 50 contracts of open interest, I'm going to be $1.50 by $1.80. 500 contracts, I'm going to be $1.70 by $1.80. 5,000 contracts, I'm going to be $1.77 by $1.80. So what do I have to overcome? I have to overcome $3 a contract, $10 a contract, or $30 a contract. Well, obviously, I want the three. Now, getting in, here's what's really hard. Getting in is the easy part. So if you were like, hey, I want to try to get in this trade, the market maker's like, hell yeah, come on in. It's a great party. Come on in. And as soon as you buy the option, you hear the door shut and lock behind you. You're like, oh, what have I done? Right? Oh no. Because when it's time to get out, you're not going to be like, hey, can we negotiate? They're like, yeah, for sure. I'm going to give you the worst possible price I can. How's that for negotiation? And that's what you get. There's no recourse there. Market makers have to maintain a liquid market. They don't have to maintain a competitive market. That's very different concepts. So we want to be very aware of open interest and what impact it has. I am unwilling. Everyone's like, oh, there's like 3,500 options or stocks that trade options. That's true. And 90% of them are garbage options. I'm not interested. I don't care. I don't care about all those. I want to have where there is lots of liquidity, lots of volume, lots of competition. Market makers are competing, and I can split the mid or split the difference between bid and ask and get in early or get in easy and out easy. I'll tell you one thing. There's absolutely no, you guys know that I will put conditional stops on options. I will never do that if I had an illiquid option because you'll just get crushed. You can't do it. Okay, great. I know it's like every one definition opens like 3 more definitions. That's the beauty and challenge of options. An option chain. When someone says a chain, what's that? That's just your quotes. That's the listing of all available options for any particular asset. It's going to show you the strikes and the expirations. So for example, well, no, that's not it. This is an options chain here. We went through this a little bit. So I have calls here, and puts here. These are my expirations and my days till expiration. That's March 8th. How much do we have? 1 day. And then 15th and then 22nd. So it's Fridays. Remember, we said purple is weekly, non-standard. If it's in black, that's the standard option, which is the third Friday of the month. So this has all of my, let me get my drawing tools out of the way. Sorry. This has all of the expirations. This is Citigroup. I've got 6 weeklies, 1, 2, 3, 4, 5, 6 weeklies. Then I've got monthly, 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 monthly. Then it skips September, October, November, December. Then I've got some leaps. If you've heard that, leaps, long-term equity anticipation. So if you're like, what's the P? The P is patient, anticipation, long-term equity anticipation securities, which is what? Options a year or more. So here you can see over here, I can buy an option. I could buy an option on Citigroup. That's 1,000 days out. That's 3 years out, basically. Right? December of 2026. I can buy these options. I'm not going to, but I could. I'm just saying. Those are your expirations. And then when I open this up, you can see I have my strike prices relevant to each one. You can see I have dollar increments here. Then it goes to $2.50. Then it goes to $5. It's not always the same. The more it trades, the more likely to have dollar increment, which is what I prefer. Most of the things, if you were to go through our group watch list and you looked, I would guarantee you that every stock we have, every single one that's on our watch list, has weekly options and has dollar increments. What does that mean? It means I have more flexibility. I can build whatever I want. 3 weeks, fine. $2 in the money, great. 5 weeks, $2 out of the money, no problem. I can do that too. So you limit yourself when you don't keep an eye on that liquidity. You'll notice here, I like to maintain volume and open interest on my layout. I don't care about the Greeks. I've told you that before. Here is volume. This is how many traded today. That doesn't mean this is going to go up by 2,590. In fact, it could be exactly the same tomorrow. If 1,295 people bought an option and 1,295 sold an option, then I had half buy to open, the other sell to close, and open interest doesn't change. If all of them are buyers, it goes up by 25.90. If all of them are sellers, it goes down. The open interest goes down. If someone sells to closing, that closes open interest, right? It stands to reason. So that's what those numbers here mean. These are definitely significant, and these are the priority. What do I want to see? A minimum of hundreds, ideally thousands. But really, the more the better, right? The bigger the party, the more fun we have. That's the bottom line. Okay. This is fun. What's next? In the money, out of the money, at the money. All you're looking at with these 3 terminologies is the relationship between the strike price, that's the contract, and the current price, right? An option is in the money if it has intrinsic value. It has intrinsic value if the option, when exercised, has value, not profit, value. So if I have a $50 call and the stock is 52, that has $2 of intrinsic value. That's not necessarily profit. If I paid $5 for the option, then $2 of intrinsic value is not that helpful to me if that's all that's left. So in the money is just looking at the relationship between the current price of the stock and the strike price of the option and letting you know if that has value now. If it has no value now, then that means it's all extrinsic value, which is out of the money, right? There's nothing there. The stock is at 52 and I have the right to buy it at 55. I have time, maybe. If that option expires tomorrow, what would that option be worth right now? Nothing. Absolutely nothing. It's $3 out of the money with 1 day left. What are the odds that it's going to get there tomorrow? None. So what's that option going to be worth? 0. So out of the money options, as they get closer to expiration, are going to lose value, of course. At the money is closest to. That definition I have on there is wrong. It's not equal to, it's closest to. There's always an at the money, sometimes 2. So if the stock is at $50.50, the 50 and the 51 are both close. Those are both at the money options. I'm not going to quibble over which, if it's $50.51, I'm not going to be like, oh, the 51's at the money, but not the 50. They're a penny apart. Come on. We're not that way. We're not going to quibble over details in that regard. It's just letting you know. So if I said, hey, let's go look at the at the money option, you'll be like, oh yeah, stock's at 50. Let's go find the closest $50. Perfect. That's it. That's all it is. That is in, at, out. Those don't have anything to do with profit. That's a hard one to remember. In the money doesn't mean it's profitable. Out of the money doesn't mean it's unprofitable. I've had out of the money options that started out of the money and finished out of the money, and they made a bunch of money, right? So if I have a expensive stock, we were looking at Chipotle the other day. It's like a $1,500 stock. I might buy an option that's $1,700, still $200 out of the money. And it might not get in the money at all, but I'll still make money if it goes the right way. So that's what's important. Time decay, we talked about that a little bit, but the Greek that corresponds is theta. So remember that that's a constant that we have to be aware of. This is another big one. I keep this on my chart. If you've ever watched my charts and you're like, Scott, what's that bottom indicator you have? Right? I have a moving average as an indicator. I have a 7-3 slow stochastics as an indicator. And I have implied volatility as an indicator. Now, implied volatility is not going to help me decide, should I or shouldn't I buy this stock or trade this stock? The only way I'm going to get down here to look at implied volatility is if I've looked at everything else and said, oh, this looks good. This looks good. Okay. For what? Now implied volatility can give us information. If the implied volatility is low, like it is now, this looks good to buy options because options are cheap. If it was back here, like it was back in October, the implied volatility is high. I don't want to buy, that means options are expensive. I don't buy expensive options. Or if I'm going to buy expensive options, what am I going to do? I'm going to buy more intrinsic value, because if I buy more intrinsic value, I pay less for time value. Okay. What else? Where was I? Let's go back. Implied volatility is the market's expectation of future volatility, critical in determining premium. So the Greeks, real quickly, I'm going to go through these. These are the we already talked about theta, which is time decay. So we have delta. If you were a mathematician or you remember math in high school or college, remember delta is rate of change. Rate of change. So delta measures the sensitivity of an option's price to changes in the underlying asset. It represents an expected change in the option based on a $1 move in the stock. So if I have a delta of 0.5, that means that if the stock goes up $1, my option goes up 50 cents. That's it. That's all it means. Delta, and this is true for all of these, the Greeks do not measure quality. They measure behavior, not quality. A delta of 0.8 is not better than a delta of 0.5. It is bigger, but it's not better, right? And people are like, well, why isn't it better? Well, because if I have a delta of 0.5 and it costs $2 per contract, if I pay $4, I have a delta of 1. And if I look at the 0.8 delta, it might cost me $5. I'll have to pay $5 to get a 0.8, or I can buy 2. Now, it's not that easy because those other contracts will lose more money from time. This is what I want you to understand. There's a lot of moving parts. So what do we need? An option pricing model to help us parse through it all. But this is what delta is. Now, how does it typically work? here's what you could typically rely on. If you're looking at an at the money option, you're going to have a delta of about a 0.5. Some people actually look at delta as a probability factor. So if an option is at the money, meaning right where the stock is now, theoretically, there's a 50-50 chance it goes up or down. Well, your delta is 50. So it's also looked at as almost like a probability, right? If I go in the money, my delta might go up to 0.7. If I go out of the money, it might drop down to 0.3. Again, I'm okay with a 0.3, especially when options are cheap. So don't get any biases about if you like in the money, at the money, or out of the money options. Let's just build trades and let the model tell us. Gamma is delta's rate of change. So delta doesn't stay the same. My delta doesn't stay 0.5, obviously, because 0.5 is at the money. If it goes in the money to 0.7, the delta had to go up. So my gamma might be a 0.07, which means that in $3, it goes 0.57, 0.64, 0.71. $3 later, my delta's gone from a 0.5 to a 0.7, right? And so the deltas will increase up to a maximum of what? 1. So gamma tells you how fast will delta change, right? I'll tell you this. The longer you have, the less gamma matters. Time is a buffer. You get to the last week, when you're falling off that time value cliff, gamma becomes a huge issue. They call it gamma risk, which means that in the last week, a trade that was in the money and goes out of the money could go from profitable to max loss in a heartbeat. We have to be really careful that last week or two if we're still in the trade. So delta and gamma both have to do with price. Theta has to do with time. Vega. Here's the way I like to remember. Delta D dollar. Delta D dollar. How much does my option change when the dollar moves? Theta T time. How much does my option lose per day in time? Vega V, volatility. Vega measures the sensitivity of an option's price to changes in implied volatility. So when I buy an option, I'm Vega positive. That means that if volatility goes up, I make money. If volatility goes down, I lose money. Well, if volatility is going to go down and I lose money, where do I want volatility to be? Low, if I'm a buyer. High, if I'm a seller. That's how Vega informs us. Vega and volatility doesn't tell us if, but how. How should I be a buyer, a seller, a spread trader? How should I trade it? But the information's there for us to react to. Okay, so let's talk about basic options strategies. Now, again, today is theory. Tuesday is application. I don't think I'm going to have slides on application days. We're just going to build trades. We're going to find a stock that looks relevant to the strategy, and we're going to build trades. Hopefully, some of them actually make sense, and we can place the trades. Make sure you're, paying attention to if we say, oh, you know what, this is just for an example. I don't think this is good. But yeah, we will be in the model building. We're not going to buy puts though. Unless we have like a potential hedge signal, and then I'll look at a buying put trade so you can see what the hedge would look like. We're bullish, very bullish. In fact, I'm not really thinking about buying puts. I'm thinking about buying calls. And if I have to protect myself, then I'll buy some puts. Buying calls is a bullish strategy where you buy call options expecting the stock to do what? Go up. Call options grant the right to buy at a predetermined price at or before expiration. That means we're going to benefit if the stock goes up, if it does it quickly enough. Because remember that when we're buying an option, the price goes up, it's working for us, but time is working against us. We have to make sure of that. So buying a put is a bearish strategy when you anticipate a decline in the asset's price. It involves purchasing put options, which gives you the right to sell the asset at a specific price at or before expiration. You are able to profit from falling prices, which can either A, act as a form of insurance against market downturns. That's the only way we're looking at these right now, is insurance, right? A hedge. Or B, we become speculators and we think the market's going to drop. Risks are limited to the premium paid for both of them. Okay, Great. What do I need if I'm going to do one of these strategies? What do I need? Well, let's just focus on what makes sense in this market, and that is being bullish and buying calls. So buying a call means I have a stock that I think looks bullish. Great. What else do I need? Right? What else do I need? I need to know. Now we need our technical analysis rules. I need to know a setup. I need to know a trigger. I need to have a stop. And I need to have at least one target, probably two. What are the two targets? I have an intermediary target, typically at an old resistance where I'm going to ease a little pressure on the trade. The percentage that I ease is dependent upon market conditions. What's the amount right now? Not much. I'm holding more and keeping less. Or excuse me, I'm holding more and selling less. In worse markets, sometimes it's half and half. There are markets where I'm like, I'm going to sell 2/3 or 75%, right? If I have 4 contracts, I'm like, I'm going to sell 3, and then I'm going to hold 1 just in case it goes further, but I'm really not expecting it because the market's just not there. So that's what we need, because for us to come in and build a trade, and this is what we're going to be doing next week, we need to have, and you'll notice we have this model, and down here we have slices. When I have a stop, a target, and a time frame, that's all in here, right? That's all in here. And so I don't think any of these have sold, have they? No. If you did the Citigroup trade, it's doing well. This is a trade that we looked at and built kind of together. It didn't fill the first day, but it did fill a little after, and it looks great. But what I need is to have the ability to come in. Let's actually see if we have, I'm going to look at some stocks real quickly here, because I think I only have one slide left. So I want to go, everything's been so strong. Ooh, okay. Amazon, bam. I have a trade by way of price action. I have this flag, it's turned. My stochastics, though, has pinched, but it hasn't turned yet. So I would say this is a bit of an anticipatory trade. But if I was going to build this, I would say, great, here's my entry. Here's my stop. And then what are we looking for? This was on earnings. That's tough. I would say we're probably looking for at least something up here. 186. So I'm getting 10 to the upside and 4 to the downside. Great. That's 2.5 to 1. How would I quantify that, though? I'm going to come into this pricing model, and I'm going to go to Amazon. And for me to know how I want to build this trade, I have to construct it in here. So I'm going to say, oh, I think it's going to go down to 172.50. That's where I'm wrong. And I think it's going to go up to 187. That's where I'm right. And I think it's going to take tomorrow's this. I think it's going to take a week. It's going to go out to the 15th. That's given me some time to make sure that I don't lose more than I'm willing to. And now what? And we're going to do this our entire next session. But now I would come in here and I'd say, all right, you know what? I'm going to go find an out of the money option. Okay, here's your first test. The stock is 176.82. What is the first out of the money option available to me on the call side? First out of the money option. This is a double gold star, because now I'm going to push you a little bit. Anybody want to try to take a stab at that one? Let's start with this. What's the at the money option? 176.82. What's the closest one to 176.82? 175. That is at the money, right? Now, everything this way which is getting more expensive, is in the money. You're paying more for intrinsic value. So this over this way is ITM, and this way is OTM, which means the first out of the money option, 180. Boom. What do? Click it. And all of a sudden now, you guys might not realize this, but if I buy 10 contracts of Amazon and Amazon goes from 176 to 1,725, I'm going to make over $1.5 million. That's amazing. Yeah, right? Can you imagine? I'm just kidding. Okay, now what do I have? Now I've got time considered. This is accounting for a week's worth of time already. And even with that week's worth, I am risking 2,200 to make 5,500. And we said we think we're getting 2.5 to 1, 5,500. Where's my divided by 2,200 equals what? 2.5? Amazing. But what's the problem? Is anyone willing to risk 2,200 on this trade? No? Okay. What have I done? I've gone down and adjusted to one contract. Just one. One contract. What are you risking? 220 to make 550. The ratio doesn't change, but the risk does. So this is how I control position size. I don't want to have to try to do this math in my head. I'm pretty good with mental math. I don't want to try to do this math with my head. I want the model to do the math for me. Right? I want the model and help me to say, this is my position size. So if I said I'm willing to risk $500 per trade, that's as good as it's going to get, 440. It's either 440 or 660. So you can either risk 60 less or 160 more. Obviously, we're going to do this one. That's close to 500. That's as good as I'm going to get within this context. And I say, great, I'm risking 5 to make 1,100. That's better than 2 to 1, right? I'm getting 2.5 to 1. My risk is controlled. My risk is justified. I've got my stop, my target. Everything's in place here. That's it. That's a trade. Now, once we're in the trade, we have to start thinking about things like, when do I tighten my stop? When do I take some profit? If I'm buying, now I'll tell you this, I don't love 2 contracts personally. If this was me and I was legitimately keeping my risk at 500, I would probably take this 180. And let me show you how fast, when you use a pricing model, you can maneuver through and figure these things out. I could take my 180 and go to 185. Now you'll notice what? I have 2 contracts for 327 of risk. So what would I do? Buy a third. And I want my risk to be at or near 500. Where is it? 491. Amazing. People are like, well, you're out of the money. I don't care. I'm not going to. So here's what'll happen. Someone's going to tell you, or you're going to hear someday, someone be like, well, so 74.1% of options expire worthless on expiration day. Do they really? I don't know. That could be true. I could have made that stat up. What does it mean to me? It means nothing to me, because I and you will be nowhere near this trade on expiration day, right? We've quantified this trade to March 15th. I'd be willing to go even longer with only one caveat, and that is that it's making money. If I get to the 15th and this thing's not making money, I'm not like, well, I still have time. For what? You're wrong. You thought X was going to happen, and it didn't. Doesn't matter what else happened. X didn't happen. You're wrong. Right? I'm not going to sit in this and wait and hope, and that's not how we do options. I'm wrong. I get out. I take my loss. I move on. And then the next one, right? Because look, there's our 2.5 to 1. And if I'm right, I'm going to make as much as I can, but I'm going to be in control the whole time. So yeah, for me, I prefer 3 contracts if possible. Because it does help for scaling, right? Right now, I would want to sell one and carry two, so that if Citigroup or if Amazon got up here to 180, 180, 181, somewhere in there. So let's put oh, sorry, that's not what I meant to do. 180. So let's go back to the analyze and let's add another strike and let's put 181 in there. And then I'm going to realign these in order. Reorder by price. So if it goes up, you can see I'm not making a lot. I'm only going to be booking I have the ability to make up to 425. And I'm only going to take like 125 to 150 on the first contract. Why? Because I want to ease the pressure. I want to take some, tighten the stop, carry the rest. If the trade gets to my target, am I worse off? Yes. If the trade doesn't get to my target, am I better off? Yes. Now here's your question. Are your trades getting to your target more or not getting to your target more? And if they're getting to your target more, yeah, don't do anything. If they're not, which is typically the case, let's be pragmatic about how we manage. Yeah. Okay. Whew, that was a lot. I didn't really, but Amazon looks all right. Okay. What do we want? We want a bullish stock in a leading sector. We want plenty of open interest with tight spreads. We're looking for a bounce, a continuation, or a breakout. Right now, we're looking mostly for bounces, bouncing off support in the trend. Continuation would be you're using Heiken Ashi candles. You might have missed the initial bounce, but you still think it's got momentum. We're not looking for breakouts. Breakout of what? They're all trending up. What are we analyzing for? Price, you're stopping your target. Time, if you're right or if you're wrong. If I'm wrong, I give it a week. If I'm right, I give it 2. And volatility, are you a buyer or a seller? Then we set up the trade. We determine reward to risk ratio and position size. Bing, bang, bam. Blammo. Bingo, bango. All the B words. Buying puts. It's exactly the same, but down. What are we looking for? A bearish stock in a lagging sector. We don't have bearish stocks in lagging sectors, so we're not obviously doing that right now. We would still want plenty of open interest with tight spreads. We would still want this to be a bounce trade, a continuation trade, or a breakout trade. We're still going to analyze for price, either stopping your target. For time, where are you? How long before you're right? How long before you're wrong? And volatility. Is it high and you're going to be a seller? Is it low and you're going to be a buyer? Then you're going to build the whole trade, determine reward to risk, build your position size. Bingo, bango, blammo. Questions? That was a lot. I know. I went over time again, as always, and I apologize, but I also don't apologize because, God, we have to go through it, right? Next week, we're building trades. If you're like, Scott, you really helped tie some things together using the model, great. Next week, that's all we're going to do. Buying calls, buying puts. We're not going to move on till we're real good there. And when we're real good there, then we're going to say, hey, if we have a good sense of what it is to be a buyer, let's flip it and let's talk about what it would be to be a seller. And then once we have the seller blocks and the buyer's blocks, then we can combine them and we can be spread traders. And we're just going to build our way into competency. Recap of today, key concepts. Options are contracts to buy or sell at a specific price. That's your strike. At or before expiration, which get influenced by factors like price, time, volatility. Buying calls, bullish. You know that. Buying puts, bearish. Yes. Transition to session 2. No. Sorry, I didn't get to this. This is session 2. Session 3, we're not gonna go to the complementary strategy of selling options. We are going to go directly into buying options application. So next time, I'm going to go through the watch list and have a couple of stocks, but I want you to do the same. When I say, all right, guys, what stock should we use? Everybody should be like, I want this one. Everybody should have a symbol. That's the task. That is the task. Other than that, what are your questions? I've given you 2 minutes for questions. There should be plenty of time. Is it helpful? I hope I'm touching on some things where you're like, you know what? I had heard that term, but I wasn't really sure what use it had or implication, or there's just a lot. And it's funny because even as I sit down and I'm like, all right, we're doing this from scratch. Every time I'm done, I'm like, you know what? We could have talked about this. We could have done, there's a lot here. Sandy says, very helpful to stop gaps in knowledge. That's the objective. I'm glad to hear that. But I get it. I get you guys are sometimes tired of looking at these white slides with text. So here's my promise. Like I said, we're not going to change the curriculum. We're just going to change our ability to practice. So next Tuesday, all on the model. We're not going to be in slides. We're going to be on the platform. So be ready with questions, be ready with trades. Let's be ready to go. Tomorrow, we are meeting at 3:15. Tomorrow's Friday, right? Yes, all day. Tomorrow, on Friday, we're meeting at 3:15 p.m. for our weekly market wrap. We'll discuss what trades we think we're going to carry, holds, why, etc., etc. Amazing. It's great to see everybody. I mean, I know I say that I want these to be more interactive, but these lecture ones are a little harder. I hope that if you have questions, you feel comfortable asking them. I really want you to feel comfortable. The questions usually lead us to great places and take us down really nice rabbit holes. So anyways, all right, guys, have a great night. I will see you tomorrow in the afternoon. And as always, happy trading.